How government created the housing bubble. Everyone remembers the hype. A house is the best investment you can make. Houses never lose value. Getting rid of down payments will help create an ownership society. Flipping houses is a great way to make lots of money. So let's take a look at these old adages and see what they have to say. A house is the best investment you can make. So the one belief about houses is that they're always going to appreciate. They're never ever going to lose value. Well, as we saw with the 2008 housing bubble, that's not always true. Now, had it been true for the most part up to that point? Yes, but we had such a set of circumstances that changed all of our basic beliefs about the housing market. Getting rid of down payments will help create an ownership society. So one of the things that we're going to look at as we go along through this chapter is that politicians always want the percentage of Americans who own a home to steadily rise underneath their leadership. It's an indication that the economy is strong. It's an indication that their leadership has been good to that point. So the problem with that and the idea of getting rid of down payments, a down payment is going to serve as almost like a security deposit for the bank. What it means is that you have money tied up in that house. If you put nothing down on that house and you have no skin in the game, then you might be willing to leave that house if a situation arises where you are going to have trouble making payments. But if you actually have put your own money into the house, then you have incentive to stay in that house. That's why banks require 20% to be able to buy a house. Flipping houses is a great way to make lots of money. So flipping houses became a really popular idea in the mid-2000s. Investors might quit their jobs, go and buy houses that they would then fix up and then would sell for a profit. The problem is that a lot of these investors started buying multiple properties and having multiple properties at the same time. Which means that when the crash inevitably came, they were now stuck with lots of properties that they could not sell, or that they could only sell at a price where they would have lost a significant amount of money. The other part of this is that by having all of these properties, what they were doing was they were driving up the price of homes that were on the market because they had taken some of the supply off of the market. The other part of this is the idea of gentrification. You're going to take homes in neighborhoods that are less desirable, shall we say, and you're going to fix them up. And in doing so, you're actually going to raise the property taxes on all of the homes within that neighborhood, which makes it more difficult for the people who already live in that neighborhood to continue to live there because they can't afford the property taxes. So there's a whole lot going on just with this first paragraph. Okay, so Woods continues with, so much for that. How far will housing prices fall? More in some markets than in others, but the fall could be substantial. When Japan's housing bubble burst, home prices declined by an average of 80%. As we'll see, the authorities assured us that such a thing could never happen. Rising housing prices weren't a bubble and couldn't be popped. Real estate is all local anyway, so prices could never decline across the country. There's also this belief that you could only see housing prices fall in a particular area of the country, that you would never see housing prices fall throughout the entire country, which is exactly what happens in 2008. These are the same people we're expected to listen to today. What went wrong? The crisis began when mortgage defaults began a substantial and unexpected increase, triggering a chain reaction throughout the entire financial sector. Now, what is a default? A default is simply when somebody has a loan and they can no longer pay on it. So you miss a payment, you have defaulted on your loan. Now, in the case of if you miss payments on your car, the bank is going to come and repossess your car. They're literally going to send a tow truck driver to your house, hook up your car, and haul it away. Well, obviously, you can't do that with a house. You can't just put a house onto a tow truck and haul it away. So what they do instead is they evict you. But this process takes between 12 and 18 months. This is called foreclosure. It takes 12 to 18 months for the bank to be able to get the homeowner out of the home, and then the bank takes over the home and is able to then sell it and get it off of their books. The standard account has explained the mechanics of what happened more or less correctly, but has done a poor job of accounting for the ultimate causes of the housing crash. You may be wondering if there's a way of knowing if we're in a bubble when we're actually in a bubble. One way is to look at housing prices. So you take all the prices for the past 20, 30, 40, 50 years, whatever, and put them on a graph. And what you're going to look for on that graph is what we call a hockey stick curve. Hockey stick curve is simply when you see a graph that is fairly flat for a period of time and then all of a sudden spikes. If you see this spike, it means that there's a serious increase on demand, and that increase on demand could be for many, many reasons. Again, it could be because of income, preference, population. But if income, preference, and population aren't enough to explain the spike in the graph, then you probably are in the midst of a bubble. If you look at the graph that we've got on this particular slide, what it does is it adjusts prices based on a baseline from the year 1890. So if a house in 1890 cost $100,000, what they did was they adjusted for inflation over the years to show you what that house would have been priced as in 1890 according to our current conditions, or comparing it to what it was like in 1890 based on our current conditions. So you can see that there's a steady decline in prices during World War I. It looks like that starts right as the United States enters the war, and this makes sense because who's going to be going out to buy a house when so many people are off fighting in the war? We also had the Spanish flu outbreak during that time, so there's probably going to be a significant decrease in demand on the housing market. The next thing that happened during that time period was the economic depression of 1920 to 1921. So again, further explains the downward pressure on prices. You see a little bit of a comeback during the 1920s, but in 1929, again, it begins declining again. 1929, stock market crash, which leads to the Great Depression. You do not see the housing market recover until about the middle of World War II, and it begins rising and peaks somewhere in the 1950s. And the 1950s are generally when we start to think of the American dream and all of that stuff that goes along with it. A little bit of a decline in the late 50s, and then fairly steady from the through the 1960s and 70s. We see a couple of spikes during the 1980s and 90s, and those coincide with the booms that occurred during those 2 decades. But notice that in the 2000s, we have a gigantic spike. When you see something like this, this should be setting off alarm bells, warning, 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 get out. This is the point where you want to get out of the market because the fall is probably going to be pretty bad. That rubber band is going to snap back pretty hard. Now here's a map that shows the percentage change in housing prices all across the United States from the years 2000 to 2010. So if you had bought a house in the year 2000 in the state of Florida, you can see that by the year 2006, your house had increased in price by anywhere between 120% and 160%. So we have this meteoric rise during 2000 to 2006. A lot of that is explained again by people moving into the state. We have a lot of in-migration from other states. We also have a significant housing boom at that time as well. but go and focus on the 2006 to 2010 map. If you had bought a house in the year 2006, look at what happens to the price of your house in those 4 years. So if you had bought a house in the state of Florida, you probably would have lost anywhere between 40 and 60% of the value of the house in those 4 years. Which states were hardest hit by this housing crash? Florida, Arizona, Nevada, California. Why does this make sense? Because these are the states with some of the highest in-migration in the country. You're talking about warm weather states, places where people want to move to. You have a lot of jobs that are being lost in the Midwest and in the Northeast. And so those people that were once living in those areas are looking for jobs, and jobs are being created in those states. So what do? You move to those states. You also have retirees from those states that are moving into Florida, Arizona, Nevada, California. What is the market doing in response to all of this influx of new residents? There's a building boom that's going on. So you have significant construction that's going on in those 4 states. And when the housing market tanks in 2006, 7, and 8, well, you have people who can no longer afford to buy those homes. So that's why you begin to see that such a great movement downward in prices on homes in those states. Now, the other state that is a little bit darker purple is Michigan. So if you had had a home in Michigan, you probably would have lost anywhere between 20 and 40%. Again, one of the industries that was hardest hit during this last economic recession was the car industry. We're going to talk a little bit later about how the government had to go in and save GM, Ford, and Chrysler. Those 3 companies shut down a lot of their automotive plants. Where are a lot of their automotive plants located? In Michigan. Later on, we're going to take a look at how much you could have bought in the city of Detroit at the height of the housing crash. What I want to do next is show you just how ridiculous some of the prices were on homes throughout the country. So here we are with our first home. Notice the bathroom. It doesn't look like it's been updated since probably the 1950s or 60s. We move into the kitchen and we see that the backsplash, which is usually tile behind your stove, behind your countertops, the backsplash in this home is made out of wrapping paper, Christmas paper, looks to be. Probably not the greatest idea to put paper right next to your gas-powered stove. Move on to the next slide. So in the next slide, what we're going to see is the outside of this home. Now, if you were to have bought this home on February 8th, 2013, the last time that it was listed, then you would have spent $250,000 on this house. Why so much for this house? Well, let's look at the address. 1950 Browning Boulevard in South Los Angeles, California. It's a triplex, so that means that it's a house that's been divided into 3 separate living spaces for 3 different families or 3 different renters. It was built in 1924, and it's about 3,000 square feet. Now, just the size of it and the location begins to explain some of the price, but it's still a pretty high price for this particular property. Now, what if you had wanted to buy this property in 2004? Remember, 3,000 square feet, built in 1924, in South Los Angeles, about a mile from the USC campus and the Los Angeles Memorial Coliseum. If you had wanted to buy this house in 2004, it would have cost you $1.6 million. Remember, it hasn't been updated since about the 1950s, and wrapping paper for a backsplash. But that's how out of hand the housing had gotten in the early 2000s. So what we're going to do is we're going to take a look at why was it so out of hand. Out of curiosity, I went and looked at the same property in August of 2018, and that same property has been fixed up a little bit. You can see there's a little bit of difference on the outside. It looks like somebody's put a little bit of love into it. The bars are no longer on the windows, and it would be selling in August of 2018 for $1.14 million. Now, this may be a single family home now and no longer a triplex, but still $1.14 million in South Central Los Angeles. Now that brings up the question, what could you buy in Wesley Chapel, Florida for that amount of money? Well, here's your answer. Take a look at this property here with a nice landscape pool with a cage over the back. We'll step inside, take a look at the contemporary kitchen, and we'll take a look at the front elevation. And you can see that this house in Wesley Chapel is 6 bedrooms, 7 baths, 6,279 square feet, which is really, 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 really big if you don't know. For those of you that don't know square footage, that's about 620 square meters. And what did this sell for in 2019? $1.1 million. So it's still $300,000 cheaper than the house in South Central Los Angeles. So what happened? From 1998 to 2006, home prices appreciated dramatically. In some markets, prices for even the most modest dwellings became astronomically high. The rise in prices spurred still more home building, and the resulting glut of houses finally began to put downward pressure on prices. So what happens is that these builders who build new homes see that there's a lot of profit to be made because home prices continue going up. So what did they do? They decided it's in our best interest to continue building homes, to build homes as quickly as we possibly can. So by them building homes and putting more homes on the market, that does even more to start driving prices down once the bubble bursts. Housing prices started to fall beginning in the third quarter of 2006. Until that time, people having trouble making their mortgage payments had been able to sell their homes, confident that they had appreciated or even just to refinance them. So if you were about to default on your loan, you were having trouble making monthly payments, you had 2 choices. You could sell your home knowing that your home was worth more than it had been when you bought it, or you could refinance. Refinance simply means going to the bank and taking out a new loan to replace the loan that you already had. So what's going to happen? You're going to have to pay closing costs. You may have to pay other fees, but you're going to end up with a lower interest rate and probably a lower monthly payment than the one that you had already had. These options were disappearing for borrowers experiencing difficulties, though. The bursting of the housing bubble had repercussions far beyond the world of mortgage lenders and homeowners. The financial system had invested heavily in mortgage-backed securities. Traditionally, a homeowner took out a mortgage at his local bank and made his monthly mortgage payments to that institution. More recently, banks have been able to sell these mortgages on what is called the secondary mortgage market to institutions like Fannie Mae, which then are entitled to receive the monthly mortgage payments associated with them. Fannie, in turn, bundles many of these mortgages together and markets them as mortgage-backed securities. When an investor buys one, he is buying a share of the pool of income that results from all of the mortgage payments homeowners make on these mortgages every month. The advantage of these securities was thought to be their diversification of risk. In other words, because they consisted of mortgages drawn from housing markets all over the U.S., they were to that degree protected against unexpected downturns in the housing sector in one part of the country. These mortgage eggs were placed in many different geographic baskets, as it were. So what is this process? Person wants to buy a house. They go to a bank and they get pre-approved for a loan. They then go out and find a house that they like. And once they found the house that they like, then they go back to the bank and they set the terms for what their mortgage is going to look like. Once the deal is complete, the bank, which would have normally, traditionally held onto that mortgage, kept that mortgage for a long period of time until the terms have been met, is now instead going to sell that mortgage to Fannie Mae or its sister company Freddie Mac or brother company Freddie Mac. So the bank is now not going to see all of the interest that would have made on that loan for 15, 20, 30 years, but they are going to make a profit off of that loan because Fannie Mae or Freddie Mac is going to pay them a little bit more than what they lent to the homeowner. They now have that money to go back out into the mortgage market and lend to somebody new. That's going to cause problems as well, because now you've got banks that instead of having only a limited amount of money to spend in terms of mortgages, they're going to have almost an unlimited amount of money because they can just continue with this process over and over and over again. The only thing that's going to keep them from handing out mortgages is, do they have enough qualified people looking for home loans, which we'll talk about a little bit later. Now, what does Fannie Mae and Freddie Mac do with those home loans that they just bought from the originating bank? They're going to bundle those together in what is called a mortgage-backed security. So basically, it's going to be an investment. They're then going to sell those. They're almost like mutual funds, but they're supposed to be much, much safer than mutual funds because they don't have the volatility of the market. They have the stability of the housing market. So the mortgage-backed securities are going to be sold off to lenders. So what happens? Fannie Mae and Freddie Mac sell those off at a slight profit, get their money back, to which they can then go and buy more mortgages from the originating banks. And so you can see how this process is continuing to work. The mortgage-backed securities are supposed to be a safe investment because, again, you're taking mortgages from all over the country. They're not just coming in from one region. They're not just coming in from one city like Las Vegas. You might be getting mortgages from Las Vegas, Seattle, San Francisco, New York, Philadelphia, Detroit, Tampa, Miami, New Orleans, Houston. You get the point. And the geographic diversification of all of those mortgages is what is supposed to make those mortgage-backed securities safe in terms of an investment. But what if the housing market in the entire country should suffer an unexpected slump and mortgage foreclosures should increase? In that case, as we have seen since 2006, holders of mortgage-backed securities find themselves in trouble. As foreclosures have increased and more people have defaulted on their mortgages, the stream of mortgage payments associated with these securities has become lower than investors expected when they purchased them. These securities go down in value, as do the companies that own them. So what happens? We have too many people who have been approved for mortgages that they should not have, and then they start defaulting on those mortgages. And who ends up holding the basket where all of these mortgage payments are supposed to go to? It's these investors that had bought the mortgage-backed securities. Out of the scandals associated with mortgage-backed securities is that the ratings agencies like Moody's, whose task it is to assess the level of risk associated with various securities, assign these assets a very high rating, often AAA. So ratings agencies have different ways that they rate different things. So if you look at like Moody's is going to use AAA, AA, single A, triple B, double B, single B, triple C, on down the line. And the closer that you get to a AAA rating, the better your rating is. So a AAA rating is the highest rating that anything can have. So that would be tantamount to a single person having an 850 credit score. Okay. If we look at FICO, then 850 being the perfect score, AAA would be a perfect rating for these mortgage-backed securities. So if you are an investor and you're looking for something safe to put your money into, you don't want the volatility of the stock market, then you might be looking at mortgage-backed securities as a good place to go to. Unfortunately, because of what's going to happen with the bubble, that's not true. Owners of these assets, who thought they were investing their money safely and conservatively, had in fact exposed themselves to much more risk than the ratings agencies were letting on. Blaming greedy lenders or even foolish borrowers for what happened merely begs the question: what institutional factors gave rise to all the foolish lending and borrowing in the first place? Why were banks selling off their mortgages? How did Fannie and Freddie come to exist? How did they come to buy those mortgages from the originating banks? How is it that they began packaging and bundling those mortgages as mortgage-backed securities? Those are questions that need to be answered. Why did the banks have so much money available to lend in the mortgage market? So much indeed that they could throw it even at applicants who lacked jobs, income, down payment money, and good credit. These are all the things that anybody should be looking at before deciding to loan somebody any amount of money. Why weren't they looking at these things? These phenomena, as well as the housing bubble and the economic crisis more generally, are consistently traceable to government intervention in the economy.